I am 52 years old and I have been through, this is my 7th bubble that I have lived through intimately. I want to share with you what I've learned because it takes a few bubbles before you get the feel of how it works, okay? So I want to talk about each bubble I've been through and what I learned from each of them. The first one was I was in high school in the 80s and we used to go skiing in New Hampshire. I'm from Boston, and my parents, along with a couple friends, got together to build condos on the side of the ski mountain we skied at. This was fabulous for me because then we could walk to the trails instead of waiting for my parents to drive me. Anyways, they built these homes. It was fabulous. It went well. They made money. It was great. Now, this was the savings and loan bubble where, the government, almost every bubble is created by some sort of government regulations or policies. If it wasn't for the government manipulating the economy, some industries would go up, some would go down, but when everything goes up together and down together, it's usually a government thing. Anyways, they were creating the interest rates to be artificially low, especially for housing. So my parents did this. It was great, and it went well. So they all got together to do it again. And in 1990, the whole thing fell apart, whatever, with the savings and loan crisis. Interest rates shot up. And that was the end of it. And my parents and their friends got stuck halfway through building all these other condos, and everybody was stuck. And the lesson I learned from that is my whole don't be late to get out, and don't be, what's the saying, bears make money, bulls make money, pigs get slaughtered. Not calling my parents pigs, but they did so great on that first round of condos. If they just stayed there, they would have been great, but they had to do it again. And my father had a business, a great business that he had, and all of a sudden he's a real estate guy, right? That's the other thing is just they went for a little too much. And the other thing I remember learning too, and these were all like their friends, and we'd all be skiing together, and I heard about all of this, and I remember everybody was stuck with real estate that they couldn't afford, and then they owed banks money, but they didn't have the money. And it was a whole thing, and it took a while to get resolved. And I remember that's the problem with the crash, is you get stuck with shit you can't get rid of. And everybody's frozen, and until that works its way through the system. So that's one of the advantages. If you don't get stuck with shit, when the market crashes, you are free to move on when prices are low and then act, and you're not stuck with dealing with the mess from the previous bull run. Okay, next bubble, I actually lived in Japan for a year, 1990 to 91. That was the peak of the bubble, and I remember I majored in economics, and and back in the 80s we learned about Japan. It was an economic miracle. It looked like they were taking over the world, and I was, and that was not the only reason I went to Japan, but that was an interesting point. I went there, and I was teaching English, and I would talk to people about, is Japan taking over the world, sort of, and they would look at me like I'm crazy. Like, Japanese people were like, no, we are not world leaders. Like, they were just so humble and mellow, and I'm like, okay, so these people are not taking over the world, and anyways, the bubble popped. And I guess I came away, when I came back to America, so the Japanese, market was still super high. It literally popped while I was there, the peak of whatever amount. That I can't remember I don't think the market still is back to that peak, like from 40 years ago, 30 years ago. But I remember when I came back to America, I was like, oh my God, the Japanese market is going to crash. Because it was so overvalued. Just like I said, by talking to people in Japan, it's like, it's great. It's a nice place, but they're not taking over the world, and everything shouldn't be so extremely expensive. It's just overvalued. And I was like, well, so that's wrong. The valuation is wrong. So it's going to crash, right? Well, what happened was it just slowly went down for, I don't know, like 20 years. It just slowly. And so the lesson I learned there is, it's important to be on the right side of the trade, which was Japan was overvalued. But you can't do the timing on it. Doesn't mean it's going to correct in a minute. and in Japan's case, corrected over 20 years. So it's important to know the direction and bet accordingly, but don't expect it all prices and it goes in the other direction as well. If something is undervalued, doesn't mean it's going to go up right away. So that was that lesson. 1999. So I was early on the internet with an e-commerce business, and during the bull, the crazy internet bubble with stocks. And I remember I used to go out with friends, and I remember when Alan Greenspan said we have irrational exuberance. This was in 1996. 4 years before the peak, it felt like things were expensive. They went up a fair amount. And actually, he might have been right, because so in the internet bubble, it was 1996, and it peaked, and then when it finally crashed a year or two later, it was back to 1996 prices. So it was just going over fair value when Alan Greenspan said it was getting too expensive. He was right, but, so that's one lesson is, just because something is getting expensive doesn't mean it can't get a lot more expensive. Now, the other thing was, I remember I was hanging out with my friends. We had this one friend who was 6 feet 9 inches tall. And there was a stock with the ticker was tall. And they all were bought it like 30 cents. And, everything went to $5. And I remember I looked it up. I'm like, it's not even a real company. It was just a pure fake pump and dump security that it was just stupid, right? And I was like, I'm not getting involved, and it went to $5. Some of them made a lot of money. Some of them never sold and lost money and whatever. And there were so many stupid internet stocks, the stories of like how it was such, and as somebody myself who always prized, having profits, you measure based on profits. And I thought so much of it was stupid. But the mistake I made, I was like, but I still owned Cisco, and I still owned Microsoft, and I still owned, whatever, the top tech companies, which were way up. And I would even say, I was like, well, Cisco's way overvalued. Like it's going to take 10 years of great growth for it to make this stock price, whatever it was in 1999. And although I was saying that, and although I knew that, and I knew it was a bubble, I was like, I'm in a good company. I'm holding it for the long term. And I sold some. I sold 25% of my Cisco, like in 1999. Anyways, 2 years later, that 25% I sold was worth 5 times as much as the 80% of the Cisco that I held was worth years later. I mean, Cisco, I didn't research these numbers, but I'm guessing it was like at $180, and it fell to probably $5, or something. And even today, what's Cisco at? Probably $40. Like, and there might be split adjusteds in there. I don't know, but the point is, these bubbles can be, the lesson I learned there is the bubble is more intense than you realize. It's not just the stupid shit. Like right now, it's like Dogecoin's going up. Well, that's stupid, right? And GameStop's going up. That's stupid. Well, and you're like, well, Tesla's a great company. It's up maybe a little too much. Or but it's everything. And it's more intense than you think it is. And everything can fall further. So it's, I should have sold 80% of my Cisco instead of 25%. And I should have realized that it wasn't just the small, stupid stocks that were stupid. It was the whole market. So that was that lesson. And the other thing I learned too, I was running an internet business, and I was always focused on profits. I wasn't just trying to grow. Might have been smart of me to just grow and do marketing at the beginning of the internet, but I was like, I want to earn profit. So I was growing slower, and I was solid and steady. When the crash hit, all my competitors went out of business, and I got all their business. I got, the biggest affiliates back then. And so 2001 and the crash was my best year. And so another lesson is, if you're strong and if you're smart, a crash is good for you. You can grow a lot in a crash if you're one of the ones left standing. 2007, housing bubble. I remember, in the 2000s, I remember people saying, oh, houses, it's overvalued, and oh, they could fall by 20%. I remember it was like, fall by 20%? Who cares? I remember internet bubble fell by 80%. I remember Japan fell by 80, 90%. This is nothing. Who cares about the housing bubble? But this is where I learned debt. Debt is a very important factor. So a 20% fall might not be that big of a fall off the top, but if you're levered 80%, if you only have 10% equity and the price falls by 20%, you're insolvent, you're negative, you have no equity. It's below zero. In a sense, it's a bigger fall than the stock, because when Cisco falls 90%, if a stock falls from 100 to 10, you still have 10. But if a house falls from 10 to 8, but you only had 10 in equity, you're now negative 10, right? And so I sort of screwed up the housing bubble because I was not calculating debt and the risk of debt properly. So I underestimated the housing crash. And another thing is it takes a while to get back. When you fuck up the bubble, you can lose a lot of money. It took me years to make up what I lost from that housing crash. 2015 Bitcoin bubble. Now I was looking at Bitcoin. I thought it's interesting, and then I saw it going straight up, and then I was like, okay, actually I like this. But I was smart. I was like, okay, I see it going straight up. I'm not buying now. I'm gonna wait for the crash, and then I'll get in. So it hit went over 1,000, which at the time, I don't know, went from like probably below 100 to 1,000, over 1,000 in a few months. It was crazy. Then it crashed and it was bouncing, and then it was at 500. I thought, okay, now it's down 50%, so I got some, and then it fell to 300. Or probably it fell to 400. I bought a little more, and then it fell to 300. I bought a little more. It fell to 200, and I bought more. Then it fell. I still remember the day it was at 175, and I'm like, well, I can't. This is getting crazy here. I might need to check into a mental institution at this point. I think I got enough, and I'm not gonna buy at the 175. So, the lesson there is that, again, in these crashes, the percentages matter. It's like, oh, below, first of all, they usually fall 70 to 80%. And the math that is so important is, so if something is down 50%, and then it goes down 70%, you think, oh, it's just another 20%. That's not how it works. If you're measuring from the top, if it's down 50%, to be down 70%, it needs to fall another 50% to become down 70, if you follow me on that, okay? In other words, oh my God, my stock is down 50% from its high. In order for it to be down 70% from its high, it's got to fall another 50% from down 50%. You follow me? In other words, these crashes are brutal. And so, fortunately, I was dollar cost average buying, and it worked out. Obviously, in the long run, it certainly worked out. In Bitcoin at $350-ish at the time, for my buy-in. That's what got me started here in crypto. But again, that was sort of my lesson there, is just, actually, I'd say I played it okay. I wouldn't start buying at 50% off, at least, and not so early. I would start at 70% down, or wait like at least a year. If it's still only 50% down after a year, maybe that's it. I don't know. Because these things aren't exact sciences. It's science. It's a self-similar recurring fractal that you can never predict. Then 2017, boom, in crypto. The biggest lesson I learned there is portfolio allocation. I talk about a lot in my videos now. Is really the best indicator to help you with trading. Now, again, I'm not a trader. I like to buy and hold for, usually 5 years. Now, it'll be less if I make a lot of money and I change my mind, or if I change my mind, whatever. But that's my intention. However, if something becomes, I remember Stellar, I loved, and it was one of the best of all of 2017. One of the most biggest gainers was Stellar. And I had it at like, I don't know, 10% of the portfolio at like 4 cents, and it went to 90. So I don't know what the math is on that, but if you held Stellar is now 90% of your portfolio. Okay, I liked it, but 90%, this small, tiny, hopefully in the future gonna work token that, hey, guess what? 3 years later, I don't even like it anymore. 90%? That's crazy. But at the time, I wasn't doing this portfolio allocation thing. And so to me, it was just like, well, is it expensive? I don't know. What is it? I'm trying to value it. And valuation's important. And yeah, if something's cheap, and if, you could make it more of your portfolio. But I don't care how cheap Stellar was, according to any analysis, it shouldn't be 90% of your portfolio. And another thing someone said to me, you need to respect market cap size in relation to your portfolio allocation. In other words, some tiny investment, a tiny market cap thing should not be the largest part of your portfolio, And almost by definition, the small caps have more volatility. So when things go up a lot, that's when you want to transition to these bigger cap, more stable, and your portfolio allocation should have some respect to the market cap size overall of these things. In other words, the biggest allocations in your portfolio should be similar to things that have the biggest market caps, right? In the long run. Now, again, may pick a little one. Uni is a small Uniswap is a small DeFi token I like, and the thing starts running, goes up a lot. I'll let it be a big percent, but at some point I got to pay attention. Be like, yo, this is, Uniswap's the best. It's going to be great in 10 years. It's going to go up a lot. But you got to pay attention that portfolio allocation and Uniswap should not be 70% of my portfolio at any time, right? And that's also related to the whole, if you've heard the term, the risk curve. They talk about in the legacy world that the U.S. Treasuries are considered lowest risk, but that's sort of upside down right now because I don't know that it's the lowest risk, but U.S. Treasury is the base layer. That's a lower risk, and then you've got corporate bonds, and then you have stocks, and then you have, let's say you've got crypto, and you got other, and the things, it gets more and more risky, which gives more and more volatility, and you need to pay attention of where you are on the curve. And when things go up, the high risk things go up more, and when things go down, it goes down more. And where was I? Sorry, I started getting a text. And then so, pay attention when prices are low. You want to get more out on that risk curve because things are going to turn and go up, and you want to take advantage. But when stuff starts heating up like it is now, and everything's getting expensive, you want to start moving more of that weight to the less risky, less volatile part of the risk curve. And finally, here we are in my bubble number 7, loving it, and I've taken my lessons well. I'm positioned. A lot of people know, I'm buying now. I'm getting in now. Guess what? I'm all in. I'm already in. I got no more. I'm not like, I'm buying on dips. I already bought. I got more than enough. As I say, in Ethereum, I'm irresponsibly long. I got too much. And I'm happy to have too much right now. So got in early. I'm hodling. Dollar cost averaging. Another lesson I've learned, dollar cost averaging is great, but you want a dollar cost average buy in when it's low. Now it's high. When I tell people, you want to get in, I'm like, I don't know. I feel like we're at the tail end of where it's okay to get in. But I wouldn't dollar cost average now. This thing's going straight up. So just put in what you want to put in and hope that today's not the top, right? And then, but I would start dollar cost average selling. When it's up high, you dollar cost average selling to get out. And again, I hope my timing is right here and I've learned my lessons from my bubble, but now as things get crazy and everybody's piling in, this is when I'm looking the other direction. I've always had, when I used to commute to work for a minute, many years ago, I hate it. Sitting in traffic, to me, if I'm ever in traffic, I feel like I'm just, the world, something's wrong. I'm screwing up life, right? I'm with the crowd at the same time, stuck in traffic. Like, I love it when I'm on a highway and there's traffic the other way. Like, that just makes me feel like I don't even care. It's like whatever I'm doing, I'm like, I'm on the highway that no one's on, everyone's going the other way. I feel good. Something's right about that. And the same thing with buying and selling stocks. Like, when everybody's buying, I want to be selling, and vice versa, right? And so that's how I like to be. So hopefully, this bubble, and I got to tell you, it feels like each of these bubbles, it just keeps getting crazier, each one, and, it's like surfing. I feel like this one, I've been surfing it well. But you know how it is surfing. It's like I'm on the board, and that, the wave is curling over my head, but at any minute, that stupid thing falls on my neck, and I go head over heels, and the board hits me in the head. So, no congratulations just yet. We'll wait for the crash, and hopefully I, gracefully dismounted my board and came in, and the judges hold up their things and give me a 9.9. Then I will celebrate. So far, so good, but the run ain't over. Good luck to you all.